One of the fastest market recoveries in history just happened. This week, we find out if that was a mistake. The S&P 500 crashed nearly 10% last month, then snapped back in just 11 trading sessions. But that rally wasn't built on confirmed data. It was built on hope that the large tech companies would show up this week and prove that AI is profitable, will stay profitable, and that spending on the build-out will continue. The Mag 7 names reporting this week make up 25% of the S&P 500 and the Nasdaq 100, and their earnings need to meet expectations to justify this rally. I'll give you what to look out for in just a sec, but first you need to understand why this week is so important. AI infrastructure companies have been reporting record revenues and providing rosy outlooks. This is because the large tech companies have spent hundreds of billions of dollars and are planning to spend hundreds of billions more in just this year alone. That spend flows right to the semiconductor, energy, and industrial names reporting record revenues and record stock prices. Those same companies are now dependent on the same bet, that big tech's AI build-out is profitable and going to continue for the foreseeable future. If these earnings disappoint, the entire narrative unravels. The AI trade, the infrastructure trade, the recovery trade, all of it gets questioned at once. Because remember, we still have geopolitical uncertainty and mixed signals on consumer resilience, while the oil shock threatens inflation again. Many of these stocks are also at record levels, trading at expensive valuations, on earnings dependent from big tech spending. The market has already priced in high expectations, and this week, those expectations have to get met. Watch the earnings, the Fed decision, and most importantly, the guidance they provide. Because remember, the markets care more about what will happen versus what has happened. Follow for a post-earnings breakdown and how I'm navigating my portfolio once the news settles. See you in the next one.